Section 5:1 Introduction to Beta, Practical Examples and Case Studies. 5.1 Beta Analysis of Stocks. To conduct a comprehensive beta analysis of individual stocks, you can follow these steps: data collection. Gather historical price or return data for the individual stock and a suitable market index over a specified time period. The length of the time period depends on the desired analysis horizon, but it is typically recommended to have at least 2 to 3 years of data. Calculation of returns. Calculate the periodic returns for both the stock and the market index. Returns can be calculated using either price data or total return data, depending on the availability and preference. It's important to ensure that the returns are calculated consistently for both the stock and the market index. Regression analysis. Conduct a regression analysis to estimate the beta coefficient. In the regression model, the stock's returns are regressed against the market index returns. The slope of the regression line represents the beta value. Various statistical software packages, such as Excel, R, or specialized financial software, can be used to perform the regression analysis. Interpretation of beta. Interpret the beta value obtained from the regression analysis. A beta value greater than 1 indicates that the stock is expected to be more volatile than the market, with amplified price movements in the same direction. A beta value less than 1 suggests the stock is expected to be less volatile than the market. A beta of 1 indicates that the stock's price movements are expected to closely mirror the market. A negative beta indicates an inverse relationship with the market, where the stock tends to move in the opposite direction of the market. Consider additional factors. While beta provides insights into systematic risk, it's important to consider other factors that can influence the risk and performance of individual stocks. Factors such as non-systematic risk, company-specific events, industry dynamics, and financial metrics should be evaluated alongside beta to get a comprehensive understanding of the stock's risk profile. Sensitivity analysis. Conduct sensitivity analysis by calculating beta values using different time periods or market indices to assess the robustness of the results. This can provide additional insights into the stability of the stock's beta estimate over various market conditions. Comparison and benchmarking. Compare the beta of the individual stock to other stocks in the same industry or sector. Additionally, compare the stock's beta to the overall market index to assess its relative sensitivity to market movements. This comparison can help in understanding the stock's risk characteristics within the broader market context. Limitations and considerations. Recognize the limitations of beta as a risk measure and its dependence on historical data. Consider the impact of outliers, extreme market conditions, and potential changes in the stock's risk profile. Beta should be used as one of several tools in evaluating individual stocks, and other fundamental and quantitative analysis techniques should be employed for a comprehensive assessment. It's important to note that conducting a beta analysis requires a solid understanding of statistical concepts and financial analysis. If you are unsure or require more in-depth analysis, it is advisable to consult with a financial professional or use specialized software that can provide more sophisticated beta analysis. Beta has a significant impact on stock performance and risk. Here's how beta influences these factors. Performance. Beta is a measure of an individual stock's sensitivity to market movements. A high beta stock tends to exhibit larger price swings than the overall market, both on the upside and downside. During bullish market conditions, high beta stocks have the potential to outperform the market and generate higher returns. Conversely, during bearish market conditions, high beta stocks are more likely to underperform the market and experience larger losses. On the other hand, low beta stocks tend to be less volatile and may offer more stability in turbulent market conditions, but they may also have lower potential for significant outperformance. Risk. Beta is used as a measure of systematic risk, which is the risk associated with general market movements. A high beta stock implies a higher level of systematic risk, as it is more responsive to market fluctuations. Holding high beta stocks can introduce more volatility and uncertainty into a portfolio, increasing the overall risk. Low beta stocks, on the other hand, have lower systematic risk and may offer a more conservative risk profile. However, it's important to note that beta alone does not capture all dimensions of risk. Non-systematic or idiosyncratic risk specific to individual stocks, such as company-specific events or industry risks, also need to be considered. diversification. Beta plays a crucial role in diversification strategies. By combining stocks with different beta values in a portfolio, investors can achieve diversification benefits. Including stocks with low or negative beta values can help offset the risk of high beta stocks, potentially reducing the overall volatility of the portfolio. Diversification can help spread risk across different market segments and reduce exposure to specific market movements. Beta is a useful tool in determining the correlation and potential diversification benefits between individual stocks and the overall market. Risk-adjusted return. Beta can be used to assess the risk-adjusted return of a stock. The concept of the Capital Asset Pricing Model, CAPM, utilizes beta to calculate the expected return of a stock based on its systematic risk. According to CAPM, stocks with higher betas should generate higher expected returns to compensate for the additional systematic risk they carry. Investors can compare the actual returns of a stock with its expected returns based on beta to evaluate whether the stock has provided sufficient compensation for the level of risk. It's important to note that beta is just one factor to consider when analyzing stock performance and risk. Other fundamental factors such as company financials, industry dynamics, competitive position, and management quality should also be evaluated. Additionally, the limitations of beta as a risk measure, such as its reliance on historical data and its inability to capture non-systematic risk, should be taken into account when conducting a comprehensive analysis.